ready for them, and thinking of all related aspects to them. Our panelists and experts today are Michael Levine, the CFO of Payoneer, just recently went public, Henry Portwood, Operating Director, Capital Markets at General Atlantic, Phyllis Korf, Partner at Mayer Brown, Rafi Kormeli, Growth Investors, and a Partner at Viola Growth. And I'm Noah Cole, Head of the Technology Banking Group at IDB Bank. I would like you to ask the panel any questions you might have. Please type your questions in the chat, and they will be presented to the panelists later. And let's first start with explaining why we're even focusing on the subject we're now focusing on. And I'm going to share my screen in just a second with showing really interesting data. And this is a slide that is being shared right now, shows pretty clearly the amazing IPO phenomena of Israeli tech companies in 2021. Here in the right, 48 companies went public in the first half of 2021. This is not including the great month of July with a lot of IPOs as well. And if we compare the first half of 2021 to what happened in previous year, we see only very few and not around 4 IPOs a year in previous years. Let's take a look at the left side of the slide. The overall amount raised by tech companies through IPOs in the first half of 2021 is $8.5 billion. And this is much higher than ever before, more than 60 times the amount raised by IPOs in the first half of 2021. The next slide, we're going to see some of the interesting companies that went public. The big names we can see is Playtika, SentinelOne, Monday, WalkMe, SimilarWeb, Innovate, Payoneer, Talkspace, and there are many others and others to come. And the last slide that I'm going to present now, really an interesting slide as well, is the amazing fact that in 2021, we saw a higher amount raised by IPOs than the overall amount of merger and acquisitions deals, $8.5 billion in IPO versus $3 million in M&As. And this is a very different picture from what we've seen in previous year. We can see this clearly in the graph. As an example, let's take 2019, pre-COVID year, $230 million in IPOs and $6.5 billion in M&As, 30 times more in M&A than in IPOs. And that leads me to the first question to all panelists. What is the reason for this? What makes companies, Israelis and others, go public today more than ever? And I'll start with you, Michael.
Sure, thanks Noah for inviting me.
Of course.
You know, I think the markets really are allowing companies to access capital in ways that they haven't in the past. You have a low interest rate environment, and you have new structures that are allowing companies to access markets. You know, in our case, we went public via SPAC. There's obviously now direct listings and more innovation in capital markets. I'm sure the other panelists can talk to that too. But I think a lot of it is really driven also by the pandemic, which is that because of the pandemic, you have a greater emphasis on technology, that we need technology to order the goods that we live on, to you know, get telemedicine, to communicate, and so on and so forth. And I think that is just creating a demand and a desire from the investment community to find growing technology companies and put capital in innovation. And I think it's one of the reasons why Israeli companies in particular are doing so strongly, is the fact that there's so much tech focus out of the Israeli market. So I think those are kind of a number of reasons why you see so many companies looking to raise capital to grow, but really more opportunity than ever before for new markets to develop because of innovation.
Rafi, what reason can you think about, or reasons?
I think that's a great answer. I just add two points, is that in general, I think investors or capital understand that the disruption and transformation in tech is much larger and the opportunity is great, and there's a desire to shift portfolio allocations towards technology. And just a small shift in allocation of the total amount of money that these huge institutions manage, pension funds, insurance companies, results in significant demand and there's no supply. The only way to access technology is in either you buy whatever you can in the public markets that exist, or you participate in IPOs or SPACs, or you access them earlier as private companies. But there's much more demand than supply, specifically for Israel and Israeli tech. I think the world has now realized that the opportunity set to build long-standing large companies that are going to stay here forever is just evident. So we entrepreneurs and executives have the expertise to build very large companies. It's not just what used to be called startup nation, and therefore they're voting with their feet, so to speak, or with their wallets, that they want to participate in that. And since they haven't done so earlier in the evolution of the companies, they are now joining the game when the companies become public.
Henry, what's your take?
Yeah, I would just build on both of these answers. I think Michael hit on it with the low rate environment. And when you couple that with the returns that growth-oriented IPOs have generated for investors in the US, especially in the fall of 2020, early 2021, now we've seen a little bit of moderation there, but I think public market investors have generated pretty nice alpha. And as they invest behind great new companies, there are just more and more opportunities to put capital to work. And so I think returns certainly attract more capital, and that's been true for both Israeli companies, US companies, companies globally. So I think that will continue.
Phyllis, you've seen the markets, this business more than anyone here in the conversation. What do you think?
Look, I agree with everyone. I made some notes of the questions you asked, but all three of my co-panelists here have raised every point that I wrote down. So I think we're all seeing the same thing. There is an availability of capital here. There are not many places to get returns. People want to invest in the technology sector. There have been a lot of companies that have been waiting, that have been private, that have been mature, Payoneer, right, for for a while, and waiting for the right opportunity, and then seize the right opportunity. There are also some others we see who are not quite ready, but we'll talk about that later.
So Phyllis, I'll stay with you and we'll go to the next question. Why even consider going public from the company perspective? And what companies are more likely to do so? The way you see it now, the way we see it before?
Yeah, well, I think it's sort of growing up, right? Being mature, becoming an adult. So now you have, entered the big boy, big girl world of public companies. You're accountable not only to your, 50 or 100 or 300 shareholders that you know well and have been with you for years, but now you have thousands of shareholders. There are a lot of different stakeholders in the company, but it allows you to get more visibility, more confidence from clients, from suppliers, from others, gives you a PR boost. And it just allows, and of course, the main thing is accessing capital more easily.
Michael, why consider going IPO?
Have to unmute. I'll talk more generally than specifically in our case for Payoneer, but I think, these things go in cycles. And so, CFOs in general look at a number of things. I think Phyllis ticked off most of the things on the list. liquidity is important as companies mature and you have employees that have stock options that over time will want to get some liquidity. Obviously, the ease to raise capital once you're public. But I think also valuation plays into it also. Historically, companies that were public were at a premium to companies that were private. We saw that gap starting to narrow, where private valuations were starting to approach public valuations, and a lot of companies, being public wasn't a hot thing a couple of years ago. It was pretty dry out there for people doing, IPOs. And these markets go up and they go down, and the rationale also changes over time. I think that again, sometimes there's a flavor of the month or maybe a flavor of the season, and investors are, as I think Rafi pointed out, we'll have asset allocations, and there'll be different demand. And so I think as a company, you need to think long term and not worry about what season you're in per se, but think about the long term of what you really want to accomplish as an organization and what that North Star is and what you need to get there. Capital is always a big part of that decision-making process. But I think Phyllis touched on it in the sense that being a public company is not the right thing for all businesses at any given time. There are companies that will be great public companies in the future that would not be great public companies today. And there are some private companies that would be great public companies today that for various reasons decided not to enter the public market. And there's pros and cons to being a public company. We can talk about some of those. But I think it really depends on each company and what their needs are.
Henry, what's your take on who and why should company go public?
Yeah, I agree with everything that's been said. I think that, we shouldn't underrate the branding event with customers, with relationships, with clients. We shouldn't underrate the fact that you now have a public currency to attract new talent, attract employees, and then also use for acquisitions. And then you have a currency that you can now raise more capital on, et cetera. And so I think you want to wait until you have a certain predictability of the model. You're comfortable being a public company. You're comfortable reporting on a quarterly basis, as Michael was starting to hint at. And so I think there is a certain scale and a certain readiness that we can probably get into a little bit later in the panel. But I would just emphasize all of those things.
Rafi, do you want to add on this question?
Just like Phyllis, I wrote a few things, but you guys all ticked almost all of them. So it's not fun to be the last. But I would just say, first of all, it's a very hard question that the CEO or entrepreneur or executive team really need to ask themselves. Because in my view, going public is not a goal; it's a means to achieve something. And there are alternatives, whether it's private capital or many other. And you also need to think about your long-term goals of do you want to remain an independent company or ultimately be acquired by somebody else. Not that becoming public necessarily hinders that option, but it does complicate things sometimes. The other thing I'd say is that if you're in a regulated industry or you get credibility for being a public company because somebody regulates you, the SEC, in the case of the US, then it helps. So, it could be a fintech company that you get that layer of credibility of being a public company that sometimes help you just advance your business. So those are the two things I'd add.
Okay, Phyllis, back to you. What does a fundamentally good business need to have to be successful as a public company? And in other words, or a different way to put this question, what things, legal or others, a team can prepare for 2-3 years in advance?
Okay.
Legal and not only.
Okay, so I want to cite the acting chief accountant of the SEC, who said not too long ago that a target company, he was talking about a SPAC situation. And of course, many of the companies that went public did it via a SPAC. He said they've got to evaluate the status of various functions, including people, process, and technology that will need to be in place for filing, audit, tax, governance, and investor relations. You know, that's a short quote. He said more, but you know, that really is the essence of it. You have to make sure that you have the right people in place. You know, Michael was the right person for Payoneer. He had public company experience. He knew what he was doing. Other companies that go public via SPACs do not have that person. And during the course of the SPAC process, many of them try to get that person. Not all of them succeed in finding the right process. But especially on the financial side, you must be prepared with the right people, put the right reporting processes in place. I can talk about some of this a little more later, and have the right technology. You know, for example, some private companies do not have very good records of their share ownership. And then they have options and RSUs and all kinds of compensatory arrangements and ex-employees and whatever. And they have them on Excel spreadsheets if you're lucky. And so all of that, putting that in place, putting everything in place to be able to get that to a transfer agent in a way that the transfer agent can use it, just that little function takes enormous amount of work. So we can talk about this forever, but I'm sure no one wants to. So that's it for now.
We really want to, but we don't have the time. So Michael, what would be the main financial tasks to start working on 2-3 years before going public? I know it's a big question and it's a small, we don't have a lot of time, but just to touch upon the important stuff.
Yeah, and I would imagine a lot of people dialing in are actually people who are contemplating, you know, raising capital, and if going public is the right avenue to pursue. So what I can tell you is that in making that decision, you need to think about all the work that has to go in advance, not only to just go public. I mean, people think about, you know, quote unquote, the IPO or going public. It's being a public company, because if you make it to being public and then you don't have the legs to stand on after you're public, good luck. Good luck to you and good luck to your shareholders. So I think it's all about being very methodical and planning. And in fact, I joined my company Payoneer, 10 years ago, and I started my public readiness 10 years ago. So even though we weren't planning, we were a much smaller company. We were, still in sort of that startup mode. We always thought about what we wanted to be and started getting ready in terms of what we refer to as IPO readiness. And I think there's a long, long list. Obviously, it would take the full hour just to go through that list. But I think the important thing is to think like a public company. And even if you do not go public, it is a valuable exercise because you're setting best of class standards. And so whether you go public or not, preparing to be a public company is a worthwhile initiative for any private company, even if you don't go public, because you're really trying to raise the bar across your entire business.
I would add to that, if I can, that for the folks that are 2-3 years away, not 6 months away, and it's not a technical task to execute an IPO, that's exactly the thing that they should focus on. The role of the executive team, the founding team, is to build a great company. There's many aspects of building a great company. One of it is having very strong operational foundation blocks that what they will do if you build them correctly is that they will enable you to have optionality to do whatever you want. And that's the important thing. You can go public, you don't have to go public, but if you have everything in place, besides helping you build a great company, it will keep your options open, which I think is the key, because nobody knows what's the markets are gonna look like 2-3 years from now, if you will want to, if your board will support it. So the point is, from day one, as Michael said 10 years ago, build strong foundations and keep your options open. That's the goal.
Henry, again, the same question. What other aspects
Yeah,
should be considered?
I think we've covered it well, and I think we've talked
Perfect.
about the important C-level hires that you can't miss on those for sure. I think one level down though is equally important. As CFOs build out their FP&A team, you have controllers in place, you have the right legal team in place. For our portfolio companies, often we see that being the biggest build in some ways, or at least the greatest number of people that should be added ahead of an IPO. And so I think that's certainly important as well. We also like to at least call it 12 months ahead of maybe considering a public event, start to engage with public investors, crossover investors, start to tell your story, get reps, hearing feedback, engaging with bankers is also very helpful. They know the landscape well, they see your competitors. You want to moderate your schedules, of course, but I think all of these can be helpful as you kind of just receive feedback on your readiness ahead of a potential IPO, SPAC, or direct listing.
I want to add something, Noah, something I think really would help your audience that I didn't mention, which is huge, which is you have to have the right partners. So it's not only about, and it's a great plug for all of you because obviously IDB is an important partner for us, but we have Viola as one of our early investors that really helped us grow and set us in that path. And actually for Phyllis, I've worked with Phyllis. Phyllis was our counsel for a while, so we had one of the best on the street advising us. And General Atlantic, obviously, I got to give a plug to everybody, is one of the best investors out there as well. So getting the right partners, both in terms of your auditors, your legal counsel, your investors, that will help you along that journey is so critical to success. Again, whether you go public or not, but getting the best of the best to help you. It's not about just what's inside, it's what you surround yourself with.
So we're going to touch, even though it's a pretty complicated subject, we're going to touch upon the differences between SPACs and traditional IPOs and the reason to choose one over the other. Phyllis, let's start with you. SPAC, not SPAC, pros, cons.
Yes,
Yes,
okay.
no.
And we will also post a link to just a few, I don't know, maybe 10 slides that we have on this subject in the chat, so anyone could look at it later. Okay, so I think you all know that, SPACs have been around for ages, but for much of that time were discredited, really. They were only used as a, as a last resort to save companies that were really failing. And now, of course, they have become as important, and some would say more important than IPOs. I will, this is only a personal preference, not the view of my firm, but I still love the traditional IPO, and I still think it works better. However, the SPAC has proved to be very useful, especially to companies that were ready to go public anyway. Where it has failed, I think, is that there are so many SPACs around looking for targets that sometimes companies become targets of SPAC combinations that are not ready to go public yet. And that does not bode well in the aftermarket. Okay, so what are the differences? I think the primary differences, some people would say, although there are many differences, and you can see this in our slides, are that you can use projections in SPACs because yeah, so what you're doing, and that's especially good, of course, for technology companies. So you're selling the company on the basis of not what they have done, but what people think they can do, or at least the company thinks it can do. In IPOs, those are not used, you know, as you know. I think I'll mention one more thing and then hand it back to you. You lock in your valuation when you sign the merger agreement. And for some, that certainty is really important. So you know what you have. In the IPO, of course, you go through meeting with the research analysts, testing the waters with investors, doing the roadshow, building the book, and you don't know what the price is until that pricing day. I'm talking about a traditional IPO versus now a direct listing, which is a possibility, but has not proved to be that popular yet. You know, maybe it will be. Okay, I have a lot more to say, but I'll let others speak, and
Okay.
I can. Thank you.
Ralphie, SPAC, traditional IPO, how do you view this matter?
I think there's always, at the end of the day, it probably matters less than we think. And it's, again, a means to an end. Ultimately, you become a public company, and even the pricing of the IPO or the SPAC merger, it's not, you haven't sold anything or much, and you have to live with the valuation that the public markets will give you over the many years that come after that. So I'd say that but there's always an economic trade that every deal has to be analyzed versus alternatives. So that there's just that aspect that is very unique for every situation. The more, this is a very generous and probably wrong for these applications, but like what I can say, the situation is the more unique it is, the less the more it's to go for a SPAC and less an IPO. Why? Because in an official IPO, you speak with generally more traditional investors, they have a relatively shorter time frame to do that, and you have more optionality in the SPAC scenario. Having said that, there's many great plain vanilla stories decided to go through, through SPACs. It's not a prerequisite to have a unique story to the sense. I'd say that you probably also have more, again, flexibility in a SPAC situation, structure the deal, the terms of the deal aside, the mix of secondary and primary. It's a more flexible tool.
One more question to Michael Henry. Waiting to color at this point on. I saw somewhere that more than 40% of IPO recently went like that. And you like now, not before, given the sponsors.
Yeah, I was going to say, and I felt it was about highlighting some of the aspects of SPAC transactions. In our case, to Phil's point, being able to come out of it, having some kindness during that time, really being able to offer forecasts was actually very valuable for investors. Truly, that is great. But the other part, and Phil mentioned, is that there's a wide range of sponsors. So these are the people who set up, the founders will be people who actually start a SPAC, raise the funds in an initial IPO, and have that entity that has a cash flow operating business. And there's a wide range of quality of these, these sponsors. In our case, we were able to partner with Cohen, who ran Effect Olympus, and is a legend in the space, and is known for the quality transactions she's done. And her team really helped us. We talked about surrounding yourself with partners, experienced partners that are, have the gravitas, but also bring the goods. They have knowledge and intelligence and reputation that you can leverage. In our case, we found that to be very valuable. And just to go public on an ongoing basis and have a team as advisors that will be down there.
Also, everybody was your on-class resort, and then you could talk about SPAC 1.0, 2.0, 3.0. I don't know what 0.0 we're in now, but the quality of the sponsor has improved. The quality of the institutional investor participation has improved. You have blue chip funds participating in not only the type once the deal is announced and sourced, but also even initially as more of a hedge fund sort of arbitrage community. And so I think you've seen those sponsor investors attracted to the SPAC because of the returns that really, I think, were almost supercharged last spring, sort of with DraftKings and the other names that performed incredibly well. And the financial output for the sponsors are very attractive, and as the sponsors are generating good returns, the investors are generating good returns. Also, into a massive SPAC sponsor universe out there right now. I think it's going to be interesting to see everything out of the next 12 to 20 months, just with so many SPACs chasing operating companies. So there will be, some interesting aspects, which I think has been a really interesting 24 months or so.
And for last point, last question to our audience questions. Predictions are tricky, always tricky, but I'll do it anyway. Rafi, what do you think needs to happen in the next few years in the area of IPOs and SPACs? And what we're seeing right now is what we're expecting to keep seeing between these happen.
Very hard to predict. It's probably true, like others have mentioned over the call. These things come in cycles. So I don't know if we're at the peak or we're heading towards a peak or we're at the peak, but they can stay at high. It's actually not going to go away. There's going to be a shakeout, as was mentioned, and the high quality sponsors with high quality investors backing them will continue to find companies and offer them to the company. The mix between that and individual IPOs, and all the other stuff, and large private rounds, that all changes based on where the capital is flowing in there's a macro environment. I think we'll go on. I think then their careers in environmental technology, that's not going away. Capital allocation towards wealth destruction, innovation, and investing in other asset classes will not yield similar returns, and capital will continue to seek its way into technology, and the vehicle life is less important.
Michael, what's your prediction?
Yeah, so I think it's important for the people who are listening to understand the SPAC world. So SPAC transactions are structured. They have a limited life once they raise their initial funds to go out and find their target company to merge or acquire with for 2 years. And so what you have is in the last year and a half, a tremendous number of SPACs have gone out, raised a tremendous amount of money through IPOs. That capital is waiting to be deployed. They're going out looking for target companies. There's only a finite universe of IPO-ready companies truly out there. Is that the really good companies that haven't been gobbled up yet? Those newer companies people will fight over those and bid those up, so you can see valuations, potentially even go higher as the clock ticks down on those 2 years, because if they don't have target within those 2 years, basically, there's a window you do it, and investors that will buy companies that aren't mature enough that. So I think let the buyer beware on both sides. I think there are things that issuers need to companies go public and asking themselves truly are they right and does it fit for their needs, and I think it's an important process for companies to evaluate.
Henry, for you, I'm taking the questions from more. So it's very typical, obviously, a lot of things life situation, and being very few IPOs out, after a few years. You think the was going to be right soon, meaning couldn't go over themselves, go to 25 years. It's just a cycle. Starting to take over, not conclusive. The end of the day, is there more to come from an IPO general market to traditional and SPACs coming up?
That's a great question. I think the IPO and SPAC market has just been on an incredible pace in 2020. When the headlines about last week of July was the busiest IPO week since 2000, and something like that. Like something got to give. But at the same time, to the quality of private companies that have continued to attract great private capital, continue to build up to the great operating companies. Those companies still exist at every stage of the capital cycle. I think as long as the broad market holds up, like those companies are going to find high quality capital, whether that's through a SPAC, an IPO, which I think those all into public and public company. I think just speaking on behalf of GA, we've had quite a number of IPOs this year. Our pipeline looks large again for next year, and I think we're a great proxy for a lot of other funds out there. There's a lot of companies that are still going to look to attract or to access the funds over the next 24 months. The reason why investors may take these returns valuations, but that remains to be seen. No one knows the answer to that.
Yeah, I think the public market is large ones to companies, and some of those companies are able now. And it's a matter of how long some of the initial investors are ready to wait. Also, employees and former employees, several of us did earlier, and that policy and development of the NASDAQ market is just increasing, having joint ventures with some of the banks. So I think there's more to on the private side, more flexibility, and so maybe companies won't need to go public as quickly, but I think you'll see both and those. I understand do this as well. So if you have different waiting time, you could see money shifting.
I have 50 questions, and I'm just going to do question was like Shaq is more about valuation side and for valuation. Do you think that it's okay, even though it's end of COVID and hopefully sooner? But people do think there's going to be, I would say, there's something about
okay, next slide. I think there's probably pockets of levels in different areas, definitely, and some very optimistic views on the private capital side with respect to specific sectors or companies. But I think in general, what happened in the pandemic, all that accelerated, is that the opportunity set for some companies just exploded. Their TAM is now a step function larger than what it was. And valuations are, in general, it's a bold statement. There's a linkage between your opportunity set and valuation cheap. So it's not based on it's not bubble. It's the market shifted to a place where opportunity set is much harder. And if you're fortunate enough to be part of that journey, your valuation increase quickly.
Henry,
I think over the last 8 months, I think to Rafi's point, the digital adoption for the folks on our phone, companies analytics, and so I think maybe some elements of valuation is going to be pulled forward some degree, and so there's talking about that whole thing.
They always think but good companies over the long term, they always outperform. So that's for the CEOs get out there and entrepreneurs build great companies, the rest of itself.
You see cycles, of course, but I think good companies generally prevail, even if they have difficult times. Sometimes, if there's patience and their investors stick with them, in the end, they'll be there for you. So, I think we will see some bursting of whatever little bubble or big bubble there is, but that shouldn't concern, the good companies. They just have to hang in there.
The last question from another person from our audience is, you touched upon a little bit about things that can go wrong and companies that are not ready and companies that didn't all the things are the right thing that needs to be done in order to be ready for IPO. If you can share an example of what, without mentioning names, obviously, but what can go wrong, what cannot be fully cooked, getting ready to an IPO from experience. Phyllis, you want to start? Yeah, no bad IPOs is very wrong.
We have seen companies over the years miss their final deadlines or have to do sometimes not because they simply didn't have either the people or the internal operating processes in place early enough. And it was said, acted up, they also knew them that they could not get back together. I'll just end one more thing. We've seen CEOs and CFOs speak on investors, and that also takes quite a bit of training and quite a bit of understanding the news and so those things.
I would say that moving to these more time things over time. The one thing that's really hard to fix is trust. Once you break trust in the public or even the private market for that matter, it's really hard to back to the level you're at. So I think I'll take different definitions. It could be the ability to execute, if you're saying the wrong thing, if you're just representing. But to me, there's no room for error when it comes to trust.
agree with Michael, especially the data goes out. You're a public company investor, the management team has set reasonable expectations in the quarters post IPO. I think you see companies that unfortunately perhaps missed that in the first, second, or third quarter post IPO and may trade below their IPO price. And to Michael's point, that trust manifested by where your stock price is trading is harder to rebuild. And I think it does take a lot longer, especially when you miss that action close to IPO.
Yes, that's exactly right, Henry. Managing and meeting expectations is one of the most important things.
I just augment with one thing is that you can only go public once. That's not 100% true, but generally you go public once, and the decision on when to do it is probably one of the most important ones for all the reasons that were discussed today. And at that point, I think some companies approach it as something that's very transactional versus relationship with the public markets. And if you treat it that way, it's probably going to fire back at some point. Not always. That can manifest itself, for example, in some entrepreneurs that shoot very high into the sky with very aggressive valuation expectations. Sometimes they don't get it and they have to pull back during the IPO process. Very bad. Pull the IPO completely. Very bad. Or even if they get it, it doesn't mean much. It means that the amount of capital they paid was at that valuation, but there's still the rest of the 90% of the company that to live with the results of that. So if the company doesn't trade well post IPO, it's something that's also very difficult to recover, because company investors, I think, are more cynical, and they don't have to invest in any company. It's not a must to be in any one specific company. The other wonderful thing on entry point, some companies go too early in terms of size. You really don't like a small public company in this very big ocean. You won't get the attention of the right investors and might become an orphan stock. So be patient, do what's right for the company, and don't rush it just to become a public company that's too small for the big ocean.
Yes. I'm sorry, Noah. The other thing is the attention of research analysts in an IPO. That's what people events. Research analysts who will follow you after the quiet period, 25 days. In the SPAC situation, that is not necessarily true. You have to kind of onboard research analysts and make sure you get coverage. So that's another difference between a SPAC and an IPO.
We're just about to finish, and we have lots of questions coming from Dana Perry. Most important, this is a question for you, I believe, Michael. Most important advice for CFO heading to IPO process. You touched upon it, but most important advice, if you can choose one.
Sure. As a CFO, I talk to all the CFOs listening. You feel tremendous responsibility as the CFO to lead during. Obviously, you're working with the CEO and the other executives, but you feel a tremendous amount of pressure to lead. And I want to tell everybody, it's okay to ask for help. It's okay to leverage people who've gone through the experience before. Be honest with yourself. Learn from others. Talk to people who've gone through the process. Ask them what they've done differently. Ask them for help. And don't feel that you have to be a hero and show everybody you know more than everything else. Be very humble and say, help me, let me learn from you. Go out, seek advice, and then get good partners along the way.
And this is another life, not only IPO. I really thank Michael Levine, the CFO of Payoneer, Henry Portwood, Operating Director of Capital Markets at General Counsel, Score Partner at Mayer Brown, Duffy Carmelli, Group Investor and Partner at Viola Code, and Kolb, the head of the Technology Banking Group at IDB Bank. Thank you all for joining us. All the best. Hopefully we'll see you all soon.
Thank you, everybody.